You spend hours mapping out the perfect smart money setup on the 15-minute chart. Price taps your order block, you hit Market Buy, and instantly your position is 5 pips in the red. The analysis was flawless, but the execution bled away your edge before the trade even started. Look at this quote tracker showing the bid-ask spread. Think of that gap as your broker's cover charge. The bid is the highest price a buyer will pay, and the ask is the lowest price a seller will accept. When you hit a market buy, you are forced to pay that higher ask price. Normally, that gap is tight, but watch what happens to the spread during high-impact news. The distance violently tears open. If you send a market order during this volatility, the broker fills you at whatever price is currently available, dropping your entry point deep into a negative start zone. Market orders are what the industry calls liquidity takers. When you market buy into a bearish zone, you are handing institutional algorithms the exact liquidity they need to quickly fill their sell orders. To stop bleeding pips on every entry, you have to stop acting as the market's liquidity. The solution requires transitioning from a trader who clicks a button to an execution engineer who sets strict conditions. The first level of execution engineering involves replacing market orders with limit and stop orders. Limit orders let you demand a specific wholesale price floor, while stop orders ensure you enter only when the market proves its momentum. Take a look at this candlestick chart. Instead of market buying the second price touches this green 15-minute order block, we place a buy limit order exactly at the halfway point, the mean threshold. You are instructing the broker to execute only if the market drops to your required discount. The math on this is immediate. By lowering your entry by just 10 pips, your stop-loss distance shrinks. On a standard account risking 1%, a reward-to-risk ratio that was 3-to-1 jumps to 5-to-1. But sometimes the market is moving too fast for a deep retracement. That's when you use stop orders. A buy stop buys above the current price. You place it above a swing high, and it only triggers if the market actually breaks out with confirmed momentum. Using limits and stops means you completely dictate the terms of engagement. You control entry costs instead of accepting whatever premium the market charges you. Even with strict pricing rules, staring at a chart waiting for your specific price to trigger creates psychological fatigue. True execution engineering involves automating the logic so you can walk away. Here is how you bracket a volatile setup like an ICT Silver Bullet. We set a one cancels the other, or OCO, order. You place a buy stop above the consolidation range and a sell stop below it. When price expands and hits one, the system automatically cancels the other. You can stack these further with if-done nested orders. This creates a domino effect. You tell the platform, if my buy limit is filled, then immediately place my exact stop loss and take profit parameters.
During a fast-moving New York session, a manual trader might hesitate for 3 seconds after their entry hits, trying to manually drag their stop loss into place. By the time they click, the market has already spiked against them. These automated sequences strip the manual error out of the equation. You get the psychological freedom to step completely away from the charts, knowing the entire life cycle of the trade is protected the millisecond you are filled. But even automated logic faces a severe test during major economic releases, like non-farm payrolls or CPI data. Most traders don't realize that a standard stop-loss is actually a market order in disguise. When the market touches your stop-loss price, your broker just issues a command to exit at the very next available price. Watch this chart during a news gap. The price jumps, skips right past your designated red stop-loss line, and executes 20 pips lower. The slippage distance shown here turns a calculated 1% risk into a massive capital drain. To establish an absolute floor, you use a stop limit order. This instruction says, trigger my exit if the price drops to this level, but absolutely do not sell if the execution price is any worse than my specific limit. The trade-off is clear. If the market completely gaps over your narrow limit window, your trade stays open. But by utilizing stop limits in tandem with emergency safety stops, you prevent standard slippage from turning an everyday loss into an account killer. As you scale up to trading 10 or more lots on heavy assets like gold, order mechanics get even tighter. At high volume, partial fills become a real risk, ruining the math of your entire position. Institutions rely on fill or kill, meaning the broker must process the entire massive order at your price or cancel it entirely.
Alternatively, immediate or cancel grabs whatever volume is available at your price and voids the rest, ensuring you never get stuck with a bad average. To manage profits on these larger positions, static targets are replaced with dynamic trailing stops. Once price hits double your initial risk, the stop loss steps up automatically, tracking a set distance behind the price action to capture parabolic runs. Professional mastery in trading is rarely about having better predictive analysis. It is defined by the mechanical precision of how you manage risk and secure your price. To actually deploy this execution engineer's toolkit, you need a broker with the server infrastructure to handle complex order logic without hesitation. This is where FXNX provides a structural advantage. With 0.0 pip spreads, you eliminate the spread tax on your entries, and their advanced trade terminals natively support the one cancels the other logic required for professional execution. Stop paying a premium for convenience. Download the order execution cheat sheet shown here to audit your last 20 trades. Check exactly how much capital you lost to slippage by using market orders, and start engineering your setups from the ground up.